One of the things I love to do, and my goal here is to democratize what single family offices are doing for people that may never be billionaires, but can use the same playbook.
We have strategies in venture, strategies in private equity, strategies in private credit, strategies in real estate, right? We have an RIA attached to the firm. That way we can build vehicles through it. What we realized was our largest investors are large family offices who want a manager to have the ability to run strategies for them. But real estate becomes the great wealth builder. And that's where you see a lot of people put their dollars. The bigger family offices really get creative on how they're able to play and continue to acquire more, whether or not more means more deals, more real estate off a smaller bit than their total amount is by playing with leverage smartly.
What's up, Chris? Good to have you on the show.
Thanks for having me, Justin. This is amazing.
Well, this is awesome. Yeah, you and I have, we've tried to connect a few times. And in fact, we were almost scheduled. I don't know what we were thinking, but we were almost scheduled to do our recording on St. Paddy's Day. And I think both of us are Irish, although my percentage is probably a lot smaller than yours. But I'm glad we opted for today's date.
Yeah, I think it would have been a very lively podcast if we did it on St. Paddy's Day, though.
I'm sure it would have. It's always been one of my favorite holidays of the year.
Oh, it's amazing. Again, thanks for having me. I'm glad we connected, and let's go. Let's have some fun.
Well, I'm excited to learn your story because it's not every day that we get someone that has been an entrepreneur and is an entrepreneur that is also an investor. And I'd love to learn from you, how you got into this space. When did you decide to become an entrepreneur? Was this, did you learn this from your parents? Did you figure this out at a young age, or were you much older? Like a few of my other friends I've had on the show.
Yeah, I would say older, not as old as I am now, right? I call the accidental entrepreneur or even the forced entrepreneur. So I graduated from college at William and Mary. I played sports at a high level, baseball. I started in sales right after college because, sitting behind a cubicle wasn't necessarily in my cards. I didn't think that was going to be something I would thrive at, right?
Yeah, and, I can hear you on that.
Yeah. I ended up in sales. It was great. I had the opportunity to come to California at the end of 2009. And the company I came out for, they did a big restructure, and all of us who had come out, I was 75 days after I moved to California, we were all gone.
Oh my goodness. That's brutal.
It was brutal. So you go from Williamsburg, Virginia to Newport Beach, very different cost of living, very different economics. And so it almost became necessity. It was, all right, I'm in real estate investment banking. It's 2009. I'm not sure who's hiring in that world. What activity is really happening meaningfully? And so it really was to just stay afloat. I said, okay, I got to figure this out. And, I met my wife a few months after that. We started our first company 4 months into dating, back then to a marketing firm, and kind of everything took off from there. She started a firm in 2013. I started one in 2015. We were doing high intent media buy and conversion rate optimization for high growth companies. And then I met these 5 guys and started what ended up becoming the second largest CBD brand in the world.
Wow.
And so we were fortunate enough to sell that in 21. My wife and I co-founded a liquor distillery in 2018 that we sold in 21. We sold a beauty care brand quite naturally in 2019. And then, those are the fun ones you get to put up on the wall, but there were quite a few along the way that didn't work as well, right? And that's kind of part of that journey that we all take. And at the same time, I had raised a couple funds with a buddy of mine from college, and I was an active investor. And so back in 2017, I met this guy. His name's John Garcia. He was the founder of SoCo Capital, where I'm at now. They invested in one of the deals. We took full cycle, but really at the end of the day, I fell in love with their ethos, what they do, because it's very different than just, being a venture partner, right?
Mm-hmm.
And had the opportunity to join in January 22 as a senior equity partner. And so, I spend my time looking for amazing opportunities to get involved in, bringing capital to the firm, and what I call power brokering an ecosystem, really figuring out of our 38 portfolio companies, who needs to be with whom and why, and how do we kind of 1 + 1 = 3 within the portfolio, not only as ecosystem investors, but certainly past that into how do we just drive value for our LPs, for our investors, for everything else.
Well, I'd be curious to know some of the lessons learned along the way. I mean, obviously, you had some exits, which is great. I don't know if any were big enough where you could just do nothing, but I'm sure some were sizable enough that you had the
Mhm.
capital to start the next one, or start investing on your own. So I'd be interested to hear how some of those exits kind of inform that next chapter for you, and built the confidence to do another one, because the odds of your first business succeeding are very low, right? It's like
Yeah.
95% fail within 5 years. So you had one at the beginning that was part of that 5%. You had another one. You had another one. It sounds like you may have had another one, or your wife. I don't know how involved you were, but I mean, that's a lot of exits. That's a lot of success there.
You know, I don't want to call it the spaghetti principle thrown up against the wall. Maybe something will stick, right? Um, I love getting involved in businesses where I think I can add value. So I start there, right? Said a different
Mhm.
way. Think about the Buffett model, right? Invest in what you know,
Yep.
right? So for me, in all the companies, I always sat in the chief revenue officer role because I knew how to scale businesses, especially at the time. Very different today, but this is, 2016, 17, 18, and we were really growing these businesses. The digital landscape was very different. And so I knew we could get attention, we could grow. And I knew as long as there was a direct to consumer piece, we could really do well there. And so we would try things that we thought were interesting. You know, luck plays an entirely underplayed role in all of this. Right time,
Yeah.
right place. And so I think at the end of the day, I wouldn't say I picked, I was lucky enough to get introduced to great co founders that we were able to do really meaningful things at the time. And as long as I could do what I thought I was good at and could bring value to, not just, hey, I have an idea, let's try it. Something I go, no, I have an asymmetrical advantage and I think I can do it. And here's how I will add value was really the biggest thing. But then again, look, I'm telling you about three. There are about eight more gravestones you got to cross in between you hit each of those three, right?
Right.
So we tried different things. And it was always, was I willing to put my own capital, my own time, my own energy, right? Because time and treasure are the resources we have here,
That's
right?
right.
Am I able to take those, put it in, and do I believe it enough? Because if you don't, or the small group of people you build at the beginning don't believe it, how is anyone institutionally or a VC firm or anyone else supposed to believe it, right? It's not a blank check to go do whatever you want.
Yeah.
And so it was, I'm going to go try this and get it to a place. And some, I said, may have opportunity. The education chasm's too high, or the resources needed to really scale are too big. So uh, no, right? We're gonna shut it down. And I think the big lesson is try. And whether or not you're an entrepreneur doing it inside of your own company or trying to build your own new company, the idea of try things, fail fast. We've all heard the story, right?
Yep.
But try,
Yep.
push, see if there's something there, follow some data, right? That was what we came from the marketing side. But it was really go push, go try.
Well, I love your humility to say, hey, luck plays a role. I love telling people luck plays a role. Timing plays a role. I mean, to even have had a business that could exit in 2021, I think is just you set yourself up for success, even having a business that could sell during a time of like peak valuations. I made a critical mistake in 2021 that I didn't take a couple of offers that I was given because I thought that I could time it better. We could grow it more. I mean, so I'm looking at it from the other side where it's like I learned some valuable lessons in not taking a great offer when the offer was presented, because that offer has not been presented. Two specific potential exits for me, and I'm nowhere close to what I was offered today on one of them, and the other one
Excuse me.
I'm not far off, but it was it would have been a sweetheart deal. So I love that you could pull the trigger as well, because timing matters.
Timing matters. And, I didn't grow up a country boy. I grew up in Connecticut, even though I went to college in Virginia. But there's that old saying, right? Pigs get fat, hogs get
That's
slaughtered.
right.
And I think at the end of the day, it's apropos to being an entrepreneur is we all love our baby. And let's
Hmm.
just call it that, right? It's our child. We started it. Remember the first LLC docs, if that's what you
That's right.
had, right? Like you were worked on the logo so hard because it's the most important thing, right? Like
That's
you're
right.
really trying to get this thing done. And many years later, Now someone's evaluating it and they may be tearing it apart. And you're like, my value for this is much higher than yours. And you're
That's
like,
right.
yeah, but your value is this is something you've poured your heart and soul in. But in any business, there's an actual tangible enterprise value that may not match. And so
Yeah.
sometimes it's getting over a little bit of ego or hubris to say, today, this is as far as I can take it, or as far as I'd like to take it. I want it to have a future life. Maybe that's better by somebody else to do. And this is the value of that today. Am I okay with that? Does it allow me to do something else? Or is this my opus and I want to go down with it? Right. Like
Yeah.
that's up to the individual entrepreneur. But at the end of the day, it's really coming to grips with, does my expectation of this company match the marketplace's expectation for value?
Yeah. Chris, where were you in 2021 when I needed this advice? And you would tell me I'm
about
selling, and I'd say, okay, maybe I should too.
about 40 pounds heavier dealing with attorneys trying to
Oh,
do 2
man.
deals at once. So I'm not sure I had the bandwidth, but I've definitely gotten I have my licks in, if you will.
Yeah. Well, you've had your entrepreneurial successes. What I find very fascinating is that you've also had a lot of success as an investor. And I find it very rare that an entrepreneur does well as an investor. Luckily, I've had success in both as well. But I've had a lot of hard knocks along the way also that have informed my decision making. Because as an entrepreneur, we find a way. We're optimistic to a fault. We're going to figure it out. We'll get the people. We'll get the revenue. We'll cut expenses. We'll do what we need to do to find a way. And as an investor, it's a totally different mindset. It's all. I mean, you have to step into it saying this isn't a good deal, because rationally, most deals are not good deals. And the only reason I'm going to do this deal is if I can prove otherwise, right? If I can prove that it is a good deal. So you have to start from bad deal and move to good deal, versus as an entrepreneur, it's like, I'm going to take this thing and I'm going to make it great. And here's the vision. And, I'm going to work all these hours. I'll do whatever it takes. So it's just two different mindsets. And I'm curious how you bridge that gap.
So we have a statement in our firm that one of our other partners named, and it's reckless optimism. That is what an entrepreneur needs to have almost,
Yeah.
right?
Yeah.
An investor can't afford to have
No.
that.
No, because you could die.
And
You could lose everything.
exactly. And so track record is certainly important. But here's, I think, an interesting nuance is we like evaluating, and I'm not talking about SoCo, just we as humans like evaluating the deal. So we'll sit down and you pour through the deck and you're looking at assumptions, and you're looking at market, and you're seeing like, oh, is this going to revolutionize? Some things do, some things are disruptive, some things are unbelievable to, the zeitgeist of our world. Others aren't. So we can start there and go, okay, is this something lofty enough that we want to get into? And is there enterprise value? Great, 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 great. That's validating whether or not this is interesting enough for our investors, for returns, for something we think is change culture possibly. And you can do that. That's the science part of due diligence. The art is who's sitting across you at the table. And I'm not going to say people do or don't do this in diligence, but for me, it's a very important thing, because as someone who has had a few exits, had a few gravestones, has gone through the entrepreneurial journey, which is not easy. Number one.
Right.
Number two, so I train Brazilian Jiu-Jitsu. It's what the thing is, what looks like a record behind me, right?
Okay.
I have my black belt, and the only reason I have my black belt is because I was too dumb to stop doing it a long time ago. That is an entrepreneur.
Yeah, that's good.
And I kid on the dumb part, but you get up every day and the value proposition is tough. I'm going to get up. People are going to tell me I'm not going to make it. Nothing's going to go my way. I'm going to go to bed exhausted. I'm going to work longer hours than I did in my corporate job. I'm going to eat, stuffed sandwiches all day long. And I'm going to get up and do it again and again and again.
Groundhog Day.
Groundhog Day. And some days you feel like you're on cloud nine, and some days you feel like your business is about to go underwater, and everything in between.
And they could be next door days, right? It's like one day after the other. It's like everything's great. Oh no, we're about to die. Yeah.
So I come back to, I think, a very important thing, which is when I'm across the table, I want to get to know the founder or the co-founders, right? And really understand A, values aligned, not only with our firm, but together. Because no one talks about it probably enough. When you have a co-founder, you're like the jockeys, right? Not the horse. You,
Hmm.
you're trying to see, okay, these two people aligned. Do they have clear expectations of the same goal today, tomorrow, 18 months, 36, 48? Do they step on each other's toes? Are they complementary or are they competitive? Like that is interesting. Number
Yeah.
two, I personally like investing in proven entrepreneurs. They've done it once.
Yep.
Doesn't mean they have to have had a 9-figure exit. Have they gone through the process of taking an idea, growing it, building it, nurturing it, supporting it, understand what it takes to fully bring it into a market, validated whether or not it has product market fit, understood where to put scale, where not, all of the things while it's noisy and you're trying to support staying alive. If you can do that to whatever end, when you do it again, you already know what you're walking into. You already have your level of playbook.
Yep.
When you've not done it, it doesn't mean you can't. There are great entrepreneurs, right? You did it for your first time once. I did it for my first time. But when you're evaluating the human side of it, you're saying, does this person have the grit, resilience, determination to be a good steward of our investor capital?
That's right.
And do they have the ability to do it? Yes or no? And sometimes that's longer than just something you're going to see on a 12 slide deck with an appendix,
Yeah.
right? Because it could be the best idea in the world, but if they don't understand truly what it takes to get it done, then that's a dangerous place to be.
Well, you've articulated something quite well that I love talking about, which is, I built a vetting deals course with one of my dear friends, Hans Box, who also is kind of our in-house analyst and CIO for a lot of the deals that we do in Lifestyle Investor. And we built this course, and one of the foundational concepts is that you bet on the jockey. And the jockey, like having a good jockey can turn a bad deal into a good deal, right? But if you have a bad jockey, they can easily take a great deal and make it a horrible deal. And so it is first and foremost about the jockey. And then for me, it's everything else after that: the idea, the TAM, just all that matters, just not as much to me as the jockey. So I love that
You know,
you're the same there.
I think you look at and you can look up any of these stories, right? I'm not telling anything revolutionary here, but even Stuart from Slack, right? Sold Flickr to Yahoo, made a little bit of cash, started a video game company, raised a whole bunch of money as a proven founder, was literally shuttering the company because it didn't get enough traction, but they built an internal communication tool and he pivoted it and it became Slack. One of the most
Wow.
valuable, if not most valuable communications companies sold to Salesforce. That's betting
Wow.
on the jockey.
Yep. It sure is. Yeah, I love that. And I think it's fun to kind of break down the different investment sectors. So one of the things I love to do, and my goal here, is to democratize what single family offices are doing. So the groups that manage money for the billionaires, it's to democratize what they're doing for people that may never be billionaires, but can use the same playbook. And so I study data. I have access to all these reports, all this information. I love sharing it inside of the Lifestyle Investor Mastermind community. And one of the things that we find is, and this is contrary to what most people believe, most people that I've run across, that people that haven't had exposure to our education, they think that the wealthiest people typically make their money in the stock market. Which is not the case. And in fact, the wealthiest families in the world only have about 15 to 25% of their net worth in the stock market. And often it's so that they can borrow against it to go buy alternative assets, right? And so we're going to talk a little bit about this because you guys specialize in this space. But what I want to make clear for everyone is that in the last couple of years, these reports and the reports from Goldman, the reports from JP Morgan, the reports from KKR, Apollo, UBS. I mean, these all are spitting out almost identical data, just all within the same wheelhouse, that most of these billionaires, um, 50 to 60% of their net worth is in alternative investments. And so I share this because if you break it down even further, well, what's alternative investments? Well, real estate, private equity, private credit. Well, we can break down private equity a little bit more into venture if we want to. And so you see the wealthiest people that have anywhere from 4 to 10% of their net worth, unless they are in the industry, know it better. Maybe they might go up a little higher to 12 or 15%. But generally, we see about 4 to 10% there. And then we see about 20 to 30%, often even 35 to 40% in private equity. And so I'd love to hear your thoughts. Anything you can share on the difference between the two. But B, any of your findings, anything, because you've been in this space for a while now.
Yeah. So I'll plug SoCo for 1 second, but I promise you I'll bring it back around. Really, when you look at SoCo, we're a private investment firm, right? We have strategies in venture, strategies in private equity, strategies in private credit, strategies in real estate, right? We have an RIA attached to the firm. That way we can build vehicles through it, right? And help our portfolio companies. What we realized was, to your point, our largest investors are large family offices who want a manager to have the ability to run strategies for them.
Yep.
And so, what we're known for is the venture side. We do a lot. We have about 38 holdings in, series seed through B, anywhere from, $500,000 to up to, upwards of $10 million in these companies, right? And so when you're looking at that strategy, it's very different, right? On a risk adjusted return perspective, you're earlier stage. I
Yes.
like personally being in this kind of A, B range. I think you remove a lot of execution risk, but still have a great return. Now you get to private equity and, to kind of take a step back, and I'm sure a lot of your listeners know this, but I would always say this kind of quick version of private equity versus venture is venture is a minority stake. Private equity is a majority stake, a controlling stake. Could be one company or it could be a strategy to roll up a bunch of them. One is going to reinvest their profit dollars, if you will, or revenue dollars in the continuation of growth, and many times won't be profitable for a long time. And that is okay on strategy. Private equity, they are traditionally already kicking off profit dollars, which
Mm-hmm.
means you now control a company or multiple companies you've rolled up that are kicking back dollars to pay off any debt dollars you used to buy them and returning you money every year. And so those are very different strategies. One is looking at MOIC, or multiple of invested capital, on a long-term 5 to 7 years. I'm going to invest $1 and hope to make 8, 10, 12 back over this period. The other is I'm going to invest $1 and maybe at exit in 5 to 7 years, I'm going to get 2 to 3 times my money. But along the way, I've been taking distribution. So my internal rate of return, my IRR, will be nice every year because I'm getting cash flow back.
Right.
Right. And so those are very different ways to look at it. They all kind of fit in that alternative bucket. And you mentioned private credit, which is a great thing as well, which is saying, I would like to use either cash dollars that I have and make an return on it every year, simple interest, or if it's in a retirement account, right, tax advantaged. But my risk is maybe that entire vehicle going default, but probably not because it's backed by real estate or other things. But I'm going to put money in and get a return. That's all I
Yep.
want. And I want it to be fixed and a little bit higher and less speculative than maybe buying a mid cap or small cap strategy in the market, right? But real estate becomes the great wealth builder. And that's where you see a lot of people put their dollars or things associated with real estate. And so I go back to, at the firm, we started it this way so that we could provide these strategies for investors who are looking to diversify in the way that you did, right? Because any way you slice it, a good kind of weighted portfolio, and I am not a financial planner, so please, not financial advice. When you look at it, your point, 4 to 10% is in any kind of illiquid long-term play. That's venture, right? It
Mm-hmm.
could be private equity as well. The rest of them are typically liquid or have some kind of calls every year that you can force liquidity into because you don't want to be locked in. Those
That's right.
dollars are sitting there, right? Capital markets make it easy because you can buy and sell on a daily basis,
Yep.
right? But what you find, to your point, and again, this is some advanced tax planning. I'll say way over my skis, so I don't want to go too deep here. But yeah, you have X amount of dollars of family office in the market. You can take margin at good rates and you can take that, invest in real estate, use the rental rates, the rental fees that are coming in to pay off that loan that you took from yourself.
Yep.
Well, that's pretty interesting, right? But
Most
it has to be in
certainly.
the capital markets. It has to be something you can securitize enough to take the dollars out. So you find that the bigger family offices really get creative on how they're able to play and continue to acquire more, whether or not more means more deals, more real estate off a smaller bit than their total amount is by playing with leverage smartly. And so that's typically the piece that most people miss is they're able to take assets they have, leverage them into new assets, pay those assets off, wash and repeat. And it's been happening for many years.
Yeah, I love it. And I love the way that you kind of described it. It's like, hey, there are pros and cons to each of these. You just need to understand them. It's not that one's better than the other. It's that you want to use them in tandem at the right allocations. So that way, no matter what the season is, you have the potential to make a good return. And I just think so many new people that join our community, they want to expose all of their money to like get the highest return they can. And we always tell people, hold on, don't rush into anything. Let's focus on education. Let's focus on building out the foundation, investor IQ, investment criteria, goals and dreams. Like let's do all this stuff first, because the goal is not to maximize every dollar. The goal
Mhm.
is to put a certain percentage at risk and put a certain percentage at no risk or virtually no risk, and to have different percentages in each of these different asset classes, because that's how you make money in any season, right?
And you talk about it as the difference between wealth preservation and wealth creation,
Right.
right? And there should be a portion being preserved and a portion continuing to create, kind of dumping that coal back in the fire, right? And
Yeah.
as a percentage basis, naturally everything will continue to go up over time.
Yeah. And something else that you guys I think have gotten into recently, or maybe it's for a while. It's a niche that I love investing in, and that's pro sports. And I'd
Mhm.
love to hear some of your thoughts around that because, and I interviewed Christopher Zook on my
Yeah.
podcast, who's done a bunch in the pro sports space, as a feeder to one of the bigger names. And I'm very bullish on pro sports. I'm very bullish on media rights, which kind
Mhm.
of control the valuations there of pro sports. And with streaming coming into play and all these different opportunities to really grow valuations. And by the way, I've already had my first exit on one of the pro sports teams that did have a minority equity position transfer, right?
Amazing.
So I'd love your thoughts around it.
Yeah. So, two things. One, kind of for full disclosure, we haven't made a placement yet in a pro team, and there's a reason. And you hit on a lot of them. And it's truly understanding for some of these leagues, when you're established league, right? If you're doing a minority stake in a large kind of big five sports team, these are media companies.
Hmm.
So you're trying to evaluate them as media companies. They used to be great tax havens, right? For very wealthy families to invest in because they would lose money. Well, to your point, TV rights and digital and everything else, they've become these masterful media companies with unreal valuations. I'm sure you saw the Lakers huge valuation on sale,
Oh yeah,
right?
10.1 billion.
Insane. And so I think, uh, he bought that what for a couple 100 million back however many years ago. I don't
Yeah.
care how you slice it, 30 years, it's a great return,
Oh yeah.
right? And so
Incredible.
you have to have this long vision, which in venture starts breaking down, right?
Yes.
Because we don't do long vision necessarily, right? I wouldn't call 5, 7, maybe 10 years this long vision. So that
Right.
becomes a little tough.
Well, and to a certain degree,
B,
it's just getting to the next round. It's like doing what you need to get to the next
mhm.
series, right?
But as a invest and hold, I have quite a few friends that own teams in both football and basketball, and certainly they were family businesses, right, for many years, and they'll pay unbelievable dividends for that family. And so you could assume the same thing to say in the next 20, 30 years, being a minority investor today, not expecting a distribution today, but being part of something that many years from now could sell is great. The problem I'm seeing, and there are a lot of people who have forgotten more about investing in sports teams than I know. So I want to also be careful. But when I look at valuations on emerging markets, emerging leagues, and certainly after Wrexham and Ryan Reynolds and that whole thing, looking at some of the, second and third tier teams in Europe, um, their valuations are out of whack for what they can do. They're selling you the dream, not selling you the company
I agree with
today.
that.
And so what really becomes tough is evaluating it and saying, well, we're not Ryan Reynolds, right? I don't have a
Hmm.
production studio. I'm not going to get a documentary on Netflix. Like, how am I going to take this $3 million investment in a, fourth tier league soccer team or European football team, excuse me, and make them into a 10, 20, 30x in a reasonable amount of time,
Right.
right? That's where, do those players come to Wrexham because they want to play in that team or they want to be associated with Ryan Reynolds
Right.
and right? Like there's some intangibles that are amazing to look at, but are very difficult to repeat. And so we've had some things come across, certainly my desk, where on the surface you look at some of the other investors and you go, that's really interesting. Household name musicians and athletes trying to buy another team in Europe. And you're like, yeah, but these valuations are way out of whack. And how are
That's
you
right.
getting there? And you don't make any money unless you move up leagues. And what's the strategy for that? And
And
right,
you're
how are we
not
getting the
getting
players to do it?
distributions during season, or I mean, this is a true play where you're sitting and holding, and you're hoping valuation goes up because you're only making money on the sale.
Correct. And then what you find is a lot of the minority sports teams here in the US are long-term investors trying to sell their minority stakes out. And so they're
Hmm.
at a premium naturally. These usually aren't distressed, but it's people who want to come in for a, 4% of name the team type play.
That's
And you're
right.
back to you're as a minority shareholder not getting any rights. And forgive me here, it ends up being a vanity play.
Yeah,
And
100%.
again, doesn't mean you can't make great money. But as a sponsor, for lack of a better term, of deals, it's hard for me to do that. Now, what we do is we love sports as a category, right? As a business. And so, we have a CPG brand that's associated on the sports side and have their drinks in a lot of the main sports leagues. We have a company called AI.io, which is AI for scouting and player development. Unbelievable company out of London. It's saying this entire industry is very interesting and there's a lot of changes happening
Yeah,
as it kind of grows global. How do we participate there? And so I'll equate it back to the old gold rush, right? Like, let's go picks and shovels, not be out there panning. And it doesn't mean that there's a great opportunity to go pan, but I'm not sure which sports franchise in Europe is going to be the one that makes it versus the one that stays in tier 4 forever.
that's right. Yeah, all good points, Chris. And, it brings me back to just this idea of building, scaling, and exiting across different industries. You've had a lot of experience with it from, marketing agencies to health and wellness brands, now cutting edge tech. So, how do you approach building value across such diverse sectors? And what consistent principles have guided your success?
So when you talk about adding value, if it's personally me, I look at it and go, I have this kind of book, if you will, or story of where I've had successes and failures. So learn from the battle scars. Let me share with you things, right? So if I'm sitting on a board or mentoring or doing whatever, it's let's talk through where you're trying to go. And I've probably seen that chapter before, right? And I can tell you how it ends.
Hmm.
Number two, I think what's really interesting from a firm perspective is SoCo being very different in that we have about 40 on staff, and these are all seasoned operators. And so when you're doing earlier stage investing, almost like private equity, we have teams that we put in secondment or on secondment as second jobs inside of these companies. It's not mandatory, but you could assume most series seed or A don't have fully baked executive teams. They
For
don't have
sure.
full of CFOs. We can go in there and help them see what they're not seeing. And again, during this formidable time of growth, we get to be there helping them scale. And I think that's really important. I wish I had it when I was doing it, right?
Yep.
We raised money for one of the companies, but the other two were self-funded. So it was very different. We're sitting there as entrepreneurs looking at each other going, none of us have done this before. So we're going to try. Right. But
Right.
it would have been great to have a group of individuals whose interests align sitting there going, here's a way you can do it. And here's some pitfalls to avoid.
Yeah,
Right.
that's
Those
good.
are the biggest thing. Now, really, when you talk about value across all these sectors, I think, and it's a gross generalization, but to be a good venture private equity partner comes down to a couple of things. You have to know what you're looking at, one, right? That comes from experience.
Yep.
But number two, when we talk about it at the firm, and I talk about it a lot, is the idea between capital and smart capital. Now, that sounds very cliche, but smart capital is what can it do for you more than just sit in a bank account or a balance sheet waiting to be deployed. So when we make investments, you get from our firm the breadth of the years of experience, sure, on operations, but think about more the network.
Yep.
And so when you're a entrepreneur who's been building something amazing, and if you met someone at this company, this industry, this area, it could be a game changer. Hopefully those resources you brought in from a capital can help you do that, which is why if you're building a healthcare company, go find amazing partners who really understand healthcare
Yeah.
because they're going to open up doors.
Yep.
If you're
100%.
doing something in sports, go get amazing investors and firms who do a lot in sports because they're going to actually bring value more so than just someone who wrote you a $500,000 check and says, let me know how it's going.
Yeah.
Right. And I think that's where our partners, we're all come from different backgrounds, have different ways we look at things and can help add that value.
Yeah, I like it. And I like that you're talking about the derivatives as well. So pro sports, depending on where you're investing, what you're investing in, hey, a lot of opportunity there. But let's look at these derivative businesses. Let's look at these other niche supporting, we could call it sectors or subsectors, the way you can use technology for it. But you're doing this also across the board of all these companies. And so I love that you guys have that expertise. This has been awesome, Chris. Thanks for spending some time with us here today. Where can our audience learn more about you and learn more about SoCo?
Yeah. So SoCoCapital.com, nice and easy. I'm on Instagram and LinkedIn, Chris M as in Michael Van Dusen. Both the same on both of those. Love to connect. And then happy to answer any questions for anyone. Would love to chat.
This is awesome. Well, I appreciate you sharing so much with our audience and taking the time to break down sometimes what many would consider complex subjects or topics. Investing, I think, can be challenging for a lot of people, but I think you did a great job of really simplifying it across multiple different asset classes. So thank you for that. And I love ending every podcast episode with a question for our audience. So if you're watching this, if you're listening to this, my question to you is the same each week, but what is one step you can take today to move towards financial freedom and really just move towards living a life on your terms, one that you desire to be in? So most people spend their lives building and living a life by default. What can you do to live a life by design? And what can you take from what Chris shared today to move you one step closer? Thanks so much, and we'll catch you next week.